Hello, hello. If you have been a long subscriber in my channel, if you have been around for a long time, you do know that I love cyclical stocks. They are super nice because if you buy them at the proper time, you can make some very, very good money and sometimes very soon as well. So, for instance, Ford is a company that I have traded recently. I think I bought it back in 2020 or so. I bought it for like $8 and I sold it for 18 or something of that sort. And then I forgot about it because that's how you treat these kinds of stocks. Of course, as you'll see here, for instance, in the 6 month chart, it has gone up to 25 even, and I sold it earlier than that. And if you take a look at the 1 year chart, you can kind of see the price action here, and then it started going down again. That's the nature of these kinds of companies. They will go up, and then they will go down, and then they will go up again. The trick is to be always buying them when they are at a low price and then sell them at a peak. Now you can never really know when pretty much the highest peak is going to be. But if you get some good pretty much return on your investment, then it's probably time to actually sell out of these stocks, out of these companies. And the thing is, I know, I guess from some experience that I've had with these kinds of companies, that it is very, very easy to pretty much see a company being at these levels over here and going up and up and up and up and be like, okay, this is doing very well. It's going up and up and up. So I'm going to be buying maybe here, for instance. And then, it goes up over here. And then you're like, maybe I should be buying a little bit more. And then you buy over here and then it drops, seriously drops after that. Because again, this is how these kinds of companies work. And you can kind of already see it here. This is a consumer cyclical sector, and it is a consumer cyclical sector because it's pretty much cars over here. And cars are tricky as well because typically they have low margins too, and they tend to not be growing too much as well. Also, they are very, very capital intensive businesses, so this means a lot of extra debt, which means more risk for the most part. Now, Ford is obviously a very, very big company, and we're going to examine this one, of course, in more detail in this video. But it's important to see, and again, if you take a look at let's just say the 5 year chart, this again, it's a little bit of a company that's going up and down quite a lot. These are like local maximums and local minimums here. And you can see it's going up and then it's going down and then it's going up, then up a little bit more, then down again. And again, this is the kind of company that's going to be acting in a similar manner, of course. And you can always take a look at the max chart here and see that the company in the long run has been pretty much doing great if you bought it back when it had its IPO days. But you will notice that this is going up and down a lot. You can kind of see the cyclical nature here pretty much vividly, just taking a look at the max chart. You can always see so many maximums and minimums here in this chart throughout the years. But let's examine the company and its financials, because when we are playing with these companies that are cyclical companies, it's always very nice if they have great financials, because this is your margin of safety. If you're buying a company that has great financials and you can get it for cheap, and it's cyclical too, then you do have some safety because you bought it at a cheap price, and then you may wait it out a little bit. There's always some risk, but if you buy it for cheap, it's a very, very good idea. Like, for instance, buying it somewhere around these levels. I think I bought it again somewhere around here when it was like near 8 or so, somewhere around that level. Okay, so if you take a look at the P ratio of the company right now, is rather low, which is kind of to be expected for a company of this sort. Again, it's a company that's not growing, it has low margins, so you do need to be buying this at a cheap P ratio, price to free cash flow ratio, which is very similar as well, which is a nice thing. Of course, these converge with each other. And outstanding shares that are about the same, pretty much, a little bit more than what they used to be, but practically speaking the same, just 1% extra. And take a look at what I told you about earlier. Total liabilities compared to free cash flow, that's a lot. That's a lot of debt that the company has. 21 years, 22 almost, to pay back all the total liabilities. This indicates that the company is not very solvent. It has a lot of debt that needs to be taken into consideration when you are potentially thinking of buying these companies. When you are playing cyclical companies, this is why it makes a ton of sense to be buying them at a low cost, at a low price, because you have extra risk, especially when you're looking at companies of this sort that have a lot of debt here. This increases your risk. That's unavoidable. In terms of the revenue growth, it's about the same or less, actually, than what it used to be 5 years ago. So as you can understand, the company is not really growing here. net income that is doing better, but free cash flow that is doing a little bit worse than what it used to do some years ago. This probably has to do with the fact that capital expenditures have increased, I'm assuming. 5-year total equity growth that is up a little bit over here for the company. And if you take a look at the net income margins, is what I told you about earlier, these are low, and it could get even lower right now in these current market conditions. So you are looking at a company that also has quite some debt to equity ratio of almost 2 over here, twice as much debt compared to the equity that the company has over here. And you may be looking at the return on equity being 26% over here and be like, okay, this is great. But remember that this has a lot to do with debt as well. So the more debt you have, the higher your return on equity would normally be. And so this can actually kind of be misleading here. So do not pay too much attention to this kind of value if the company is having a lot of debt. Now, the dividend yield of the company is about 3% over here, and you will see that the free cash flow payout ratio and the payout ratio in relation to the net income is rather low. So this is a pretty safe dividend here. Of course, we always want to be taking a look at our dividends tab here, and you will see that this is pretty irregular here in terms of what the company is doing with their dividends. And I believe they have cut their dividends at some point and plummeted, I believe, maybe a couple of years ago. This is about when I bought it, I think so. And right now, the effective dividend yield is 4% because the stock price has been going lower, and it's actually going to be even more, actually about 4% more today, because it's looking like we're having a red day for Ford, which is going to open up at about 14.32 over here. It looks like in about a couple of hours when the market opens. But let's take a little bit of a look now at the financial statements and see what the company has been doing. Now, obviously, this is a huge company. It has been doing 156 billion, but it's going down. It's been going down, 136 over here, and 2020 was even worse. Right now, it's getting a little bit better again. But again, this may have had to do something with the pandemic, but it's going down overall. And obviously, that's not a great thing to see, but it can help a potential investor get it at a cheaper price. And this is what we're examining as well. And the net incomes for 7.6 went down and then back to 17.9 billion over here, which is a massive increase compared to the slump that they had in the past few years. In terms of their balance sheet over here, you will see that the total equity is sitting at 48 billion, but the total liabilities, then take a look at this one, is 208 billion over here. That's an insane amount of total liabilities. That's a huge amount of debt over here, as you will see as well. And they do release some of that debt. It looks like they have actually, I guess, cancelled some of it. They have actually paid some back. But overall, they still have a lot of debt. And if you take a look at their cash flow statement, you will see that they have just been making about 18 to 10 billion. And remember, they had like 200 billion in terms of total liabilities, and that's a lot compared to the free cash flow that they generate. And you will see here that previous years have actually been worse in terms of their net income, of course, and it's only the adjustments that made their operating cash flow become positive over here. It's only this reason, basically, from changes in working capital, for instance, that actually resulted in extra free cash flow here. And so, yeah, this is a situation where you are looking at net income that is really different from operating cash flow. It has a lot to do with the adjustments that the company made. And for instance, they may have sold something and gotten some extra cash, and this actually really affects the cash flow. But it's more than likely a one-time thing, and it's not really important in terms of the operations of the business. Right now, it looks like they're doing much better though. And you will see here that in terms of investing activities, they're sitting at 2.7 billion gain here. So selling, actually, you see that they are mostly sellers, net sellers of investments this last year, pretty much. And they're paying very little dividends compared to what they are making in their free cash flow and basically in their net income as well. So not much of a concern over here in terms of what they are paying. But the thing that we really need to be examining here and be taking a little bit of a closer look is what the company's price would be and should be based on what they are doing financially. So is it cheap or is it still pretty expensive? Let's examine that with our tool, of course. Just quickly before I do that, I'm always curious to be taking a look at what institutions are doing with companies. And I kind of have this little handy tool over here which tells me what the total ownership of companies is throughout the quarters, and you will see that they are sitting at about pretty much the same level of total ownership from 2020 over here for Ford, that is. And it has been a little bit more, and then actually they started to cut down on some stock, and it's down to where it was back in September 2020. And you will see that over here is when they actually bought quite some of it, for instance. But you can also see what kind of institutions are buying, and institutions are buying what. And it's Morgan Stanley that's actually buying a lot of Ford right now, as you'll see over here. That's quite substantial as well, 85%, almost doubling pretty much their shares over here. And take a look at this National Bank of Canada here, an insane increase over here in terms of stock. That's interesting, very, very interesting to see. That's a massive increase. They bought a lot of Ford over here. Very, very interesting. That was June 30th, pretty much the latest quarter. And of course, you can use our tool here to discover all the finer details about who and what they have sold, pretty much, or bought, of course. Now, back to our stock evaluation tool, let's discover the price to pay. Now, the revenue of the company, again, the growth hasn't been good. And again, they lost a lot over here, tons of money over here, tons of revenue, I should say. And so we're gonna have to go pretty low here. So I'm gonna go let's just go 3 and 5. This may be a little bit too much, but let's just try that. In terms of net income margins for the company, rather low, about 4% on average. Now lately they have been doing better, so I think I'm gonna go, let's just try 4, 7, and 10 here and see what we're going to be getting. Of course, you can always look up at different analyst estimates and try your own potential projections here just by getting access to our tool. Remember that any Patreon actually has access, unlimited access to our tool over here, so you can find a link in the description box below this video if you're interested. And in terms of the free cash flow margins over here, all over the place. Again, we know why. We did just talk about it just earlier. The company has been having some one-offs and has been having negative operating cash flow some years, so this is going to be all over the place. Typically, something like 80, 90, and 100% is kind of normalized, is what you would expect. 13% for annual return over here is what we would expect from the company. And if we hit calculate, we are getting, now the current price is sitting at 15, and our low estimates over here with 1% revenue growth is $15, 32 for our medium and 55 for our high, indicating that the company is cheap right now. But remember what we talked about earlier. So 55, take a look at this one, 56 is our high estimates here based on 5% revenue growth. Now let's just take a little bit of a look at the metrics tab over here, and let's just take a look at the last 5 years. It hasn't been more than 25 for these, the company. And based on the amount of money that they're making, it would even make sense to be buying this at 55. But they haven't reached that any time in the past. So the reason for this is that these kinds of companies, because of the reasons that I mentioned earlier, they tend to be valued less than what you would value, let's just say, a software company that makes much, much higher margins, has less debt, gets much more revenue, and pretty much has higher growth. So this matters a ton. And this is why these kinds of companies are companies that I always like to be playing for circular patterns, for cyclical patterns here. So right now I wouldn't be buying this one, even though I think it has the potential to actually go back to these levels. I think it's risky to just bet on that, and it could happen, but I think there are better opportunities to be, pretty much playing for cyclical stocks here. So I would like to be buying this company. Financials are not horrible, and it's down to, let's just say, $8, $6, maybe even 10 in some situations. But not 15. This would be much, much more expensive than what I would like, because I do have risk and I want to be buying it at a price that would pocket me some money in the case the stock will actually head upwards again. And remember, this is more than likely going to be going up and down quite a lot through the years. Thank you for watching. Tell me what you think about cyclical companies and whether you are a buyer or a seller of Ford. And remember to like and subscribe if you're not a subscriber already. And I'll see you in the next video. In the meantime, you may want to take a look at this video that I made earlier about context logic. That's wish.com. I think it's an interesting one and can actually help you identify some of these sort of like traps that can save you money in the long run. And thank you for watching. I'll see you soon. Bye bye.